Hello everyone and welcome to our YouTube channel. Here we dive into the basics of accounting and unravel the mysteries of the financial world. Our goal is to make these concepts easy to understand and practical for real-life applications. In today's video, we'll explore the structure of the balance sheet and its first basic components: cash, inventory, and receivables. Have you ever wondered why it's called a balance sheet? By the end of this video, you'll understand how and why the balance sheet always balances. The balance sheet is a snapshot of a company's financial position at a specific point in time. It's divided into two main sections: assets, the resources owned by the business, such as cash and inventory, and equity and liabilities, claims on those resources. Equity is what the owner contributes and owns, and liabilities are obligations to others. The golden rule of the balance sheet is assets equal equity and liabilities. This equation ensures that every resource is accounted for and explains the term balance. Let's break this down with a simple example. Imagine you and your friend want to start a business and have a very smart idea. Where do you start? First, you need funds, and the most common source of funds is cash. So, imagine you have $100 and want to make them work as part of your business. What do you start with? You own an asset, cash. Remember we said the balance sheet is composed of assets and equity and liabilities? Typically, they are shown separately. Let's put them under each other in a table. The $100 you have is your initial contribution, and it is called equity. It represents your ownership stake in the business. So you put it there. Initially, the balance sheet looks like this: equity $100, assets 0. But wait, the balance sheet doesn't balance yet. Why? Because the $100 contribution needs to be recorded as a resource the business owns. This resource or asset is cash. Now, assets 100 in cash, equity 100. The balance sheet balances because every dollar of equity is matched by an equivalent asset. This simple example shows the basic structure of the balance sheet. Wow! Now we have balanced our first balance sheet. Well done! So, you have cash and want to do something with it. What are the options? Let's say you decide to use your cash to buy some goods. Goods will be your asset, your inventory. Imagine you buy 5 apples at $10 each, spending $50. What happens? You give away your cash and receive 5 apples in exchange. Now, what happened to your balance sheet? Your cash decreases to $50 because you spent $50. But now we have a small problem. Notice anything? Correct, $50 in cash doesn't equal 100 in equity. Balance sheet stopped balancing. What do we do now? Now we own 5 apples, and that must be somehow reflected on our balance sheet. The apples, like most of other goods, are recorded on the balance sheet as a new category, inventory. Inventory is also an asset. Here is the updated balance sheet. Assets, $50 in cash plus $50 in inventory equals 100. Equity, 100. Even though the form of your assets changed from cash to inventory, the total remains the same, ensuring the balance sheet still balances. You see, we are unstoppable. We have again made the balance sheet balance. So, you have extended your balance sheet and are thinking of the next steps. Let's imagine you don't need this many apples and decide to sell 2 of them for $20. Now you take them out of your balance sheet, find a customer and sell them. However, the customer currently doesn't have any cash and promises you to pay in a week. You trust the customer and agree to that. So, you sold the apples but didn't receive cash immediately. What happens to our balance sheet? Right, our assets, apples and cash, are now only $80 and don't equal to equity of $100. But we sold our assets, our apples, and are waiting for the money from a customer. Can that claim to the customer mean anything? Yes. It is an asset for us and is included on the balance sheet as a new type of asset. receivables or trade receivables. These are amounts owed to you by customers. So now you have receivables valued at $20, the amount the customer owes and the amount we will receive, thus receivables. The balance sheet now again balances. Assets $30 in inventory plus $20 in receivables plus $50 in cash equals $100. Equity $100. This shows how the balance sheet adjusts to reflect different types of assets while maintaining its balance. Well done again! In the meantime, a week passes by. The customer returns and pays us $20 he owes. Nice! We have finally received our cash. Now we put the cash on our balance sheet as an asset, where it belongs. This payment impacts the balance sheet as follows. Cash increases by $20 because the payment is received, and the receivables decrease by $20 because the customer settled his debt. Now the balance sheet shows assets $30 in inventory plus $70 in cash equals 100, equity 100. Again, it balances perfectly. This process shows how transactions flow through the balance sheet while keeping everything in equilibrium. Hooray! We've done it! Started the business and made our first transactions. This applies also to real life. Let's consider another scenario. When you buy goods, such as groceries, you're exchanging one asset, cash, for another, goods. You spend cash, in return you receive groceries. This transaction doesn't affect your overall wealth, but it changes the form of your assets. This is similar to how businesses manage their resources. Now think about salaries. When you earn a salary, you're exchanging your time and effort for money. The cash you receive reflects the value of your work. Whether you perceive your salary as fair compensation or not depends on personal judgment, but from a financial perspective it's an exchange of values. Okay, time to ramp it up. What are our key takeaways? The balance sheet always balances. Spending cash results in getting same amount of assets. Sales generate corresponding increases in assets. Salaries, purchases, and all other exchanges maintain this balance. Understanding this flow of resources is critical for grasping the fundamentals of accounting. In future lessons, we'll dive deeper into how liabilities and profits impact the balance sheet. Thank you for watching. We hope this video helped demystify the balance sheet, at least slightly. Don't forget to like, subscribe, and hit the notification button for more lessons. See you next time!